We now have a quick recap from the CPA review course on stock compensation concept. You already know the basic concept from your textbook chapter. Now you will review the concept and will practice couple of journal entries and one quick problem. So first they started with the stock options, and you will see most of the discussions are centered with stock options. They also talk about non-compensatory plans. So the concepts are the same what you learned in the previous lectures when you read it from the PowerPoint slides or from your textbook. However, for this non-compensatory plan, remember the textbook used a different term. They used employee stock purchase plan. So this term in the textbook is employee stock purchase plan. And Baker also explained on the first page that those type of stock plans, they call it non-compensatory plans, and you have to fulfill those three requirements by GAAP, and you don't need to record those as compensation expense. So only if those 3 or 4 requirements are fulfilled, then you will not record it. This short video you will recap the CPA contents on stock compensation. If you see, it's from FAR 7 module 3, and you only have a couple of pages. You already have the basic foundation from your textbook chapter or from the PowerPoint slides that you learned earlier. Now you will apply those concepts and recap those concepts. So if you see on the first page of that module, they talk about stock options, and you will see most of the problems, journal entries are centered around the stock option issues. And then they discussed about non-compensatory stock option, and this is the same thing that the textbook used, employee stock purchase plan. So don't be confused, the textbook used the term employee stock purchase plan. And the CPA review course also explained the GAAP requirements. If you fulfill all those GAAP requirements, then you don't need to record it as a compensation expense. For example, the requirements are that this type of stock you are giving to all employees, and when they get the chance to buy the stock, the discount will be really very small compared to the market price, and the plan should not involve in any option features. So now then they discussed about different terms that are related when you have to record the stock options, and you are familiar with that: option price or exercise price, exercise date, and the fair value that usually we calculate using the Black-Scholes model. You don't need to worry, all CPA problems, textbook problems will give you the stock option values. Then they also discuss the concept of vesting period and service period. Then you will see one journal entry about stock options, and the journal entry is pretty much exactly the same what you have seen before. Just the only one difference you will see here, the Baker book used the term additional paid in capital, but it's the same thing you already did in your chapter or the basic concept, where the textbook called it paid in capital in excess of par. So don't be confused, both are the same: paid in capital in excess of par and additional paid in capital. And either account will be accepted. You will get full points when you have to do the journal entries. And then they discussed about one example, which is stock appreciation rights, or the SARS example, that when the employees get the cash amount compared to a certain stock price versus the stock price at the end of the year, and based on that, and looking at the service years, you have to calculate the compensation expense, and at the end of every year we will adjust the compensation expense, and as needed we'll decrease it. And since we pay cash, so we usually record it as a liability until you pay it, and when the company pays it, they remove the liability. So we actually do not record any paid in capital. If you issue real stocks, then you record paid in capital. But when you have to give you the incremental amount in cash, then you record it as a liability, and later you pay it, and then you actually remove that liabilities. Now we will see one problem here. Let's read it. On January 2, Kind Corporation granted Morgan, its president, compensatory stock option to buy 1,000 shares. This is talking about the stock option. $10 is the PAR par value, and option price, call price. You know the terms. Call option means you have the right to buy the stocks at $20, and you can exercise those following the 3 years from the grant date. And Morgan, the CEO, exercised the options on December 31st of the current year. Market price of the stock was $45 at the end on January 2 when that was granted, and then end of the year it was $70. And you also know that the option, based on the option pricing model, the value of the option was given here, $30,000. So now the question is, what net amount should stockholders' equity will increase as a result of this grant and the exercise of the option? So one thing you will see here, they didn't talk about anything the service period, so we will assume that we have to record the entire amount on that day as the compensation expense, and of course we record it as a paid in capital / stock options, and we will actually show when the option is exercised. That means the company is issuing the actual stocks end of the year. The options are exercised end of the year. So now the question is, what would be the impact on your stockholders' equity? Remember, when you record the compensation expense, it is an expense. It should reduce your stockholders' equity, and then when we record it, we credit paid in capital stock options. It is also a part of the stockholders' equity, and then when you actually, these options are exercised and you issue shares, you give the shares, those will also increase your stockholders' equity, but at the same time we remove the paid in capital stock option, we debit it. Rather, we actually record our common stock when options are exercised. And of course, the company will receive the cash since the CEO is exercising the options and paying cash to buy those stock at a certain price. Now let's do the numbers. So when the option was granted on January 2, year 1, we actually have to debit compensation expense, because here on that day the CEO can exercise the option, so there is no service period. Since the options are exercisable on the grant day, we have to record the entire amount as a compensation expense. Otherwise, if there is any service period, we would allocate the compensation expense over the years or over the service period. So here, if I would like to do the journal entry on January 2, we have to record the entire value, which is $30,000, as compensation expense debit, and then we will record it as paid in capital, and we also label it as stock option. We will credit that one as stock option, so we will record the entire amount as our compensation expense and paid in capital level as stock option. So how it would impact on that on your stockholders equity? This $30,000 is an expense, so it will reduce your stockholders equity. So if I want to show the stockholders equity here, stockholders equity impact, so this compensation expense will reduce your stockholder equity, so it's a negative impact, and this paid in capital stock option amount will increase your stockholders equity, so we will show it like a positive impact on stockholders equity or plus 30,000. Now then, what happened end of the year? End of the year, the CEO exercised the options, and when they exercise the option, they of course pay cash to buy the shares at the exercise price, which is $20 per share, and total number of options was $1,000. So the CEO will buy those options, will pay cash, the company will receive cash, which will be $20,000, because each share he purchased for $20, and total he exercised all options 1,000 shares, so cash will be debited 20,000. And then we have to show the stock issuance, right? So they issued the stocks, we'll show that, and we have to eliminate this one, paid in capital stock option. Rather, now we will show it as our actual common stock. So to eliminate that, we will debit this paid in capital stock option 30,000. So let's debit paid in capital stock option 30,000. This is debit, and then we will also show the stock issuance. So when you issue stocks, what do? We credit common stock. These are the stocks that CEO purchased. We will record it at par value. Par value is $10, and 1,000 shares were purchased or issued, so this common stock will be credited 10,000, and we show the remainder to balance the journal entry as additional paid in capital or paid in capital in excess of par. So we will also do that. So this paid in capital or in excess of par or additional paid in capital, this will be the amount to balance the journal entry, paid in capital in excess of par. So let's do the journal entry and find this number. So we have debit 30 plus 20, 50,000, and we have credit 10,000. So here paid in capital in excess will be the remainder 40,000. So now let's see the impact on our stockholders equity. What happened here December 31st? Cash will not impact the stockholders equity. This paid in capital stock option we are eliminating, so that will be reduced from stockholders equity, so we subtracted that. We are crediting or showing this as common stock $10,000. It will increase our stockholders equity, and the remainder we credit as paid in capital in excess of par, so it will also increase our stockholders equity. So now if you do the numbers, you will see this 30. So ultimately the stockholders equity will be increased by $20,000 at the end of the year as the CEO exercised those stock options.